The dollar is ticking. The clock on the wall of the United States Treasury is not measuring time. It is measuring a debt so enormous, so structurally dangerous that the very machinery of American financial power is beginning to groan under its weight. Right now, as you watch this, the federal government is staring down the barrel of something that has never happened before in the modern financial era. Nearly one-third of the more than $36 trillion in debt owed by the federal government is due for refinancing within the next year. That amounts to roughly $11 trillion in U.S. debt securities that must be rolled over. And here is what makes this so uniquely dangerous. On top of that, a projected federal deficit of $1.9 trillion means the government will need to borrow even more, pushing total Treasury issuance above $10 trillion for the year. And over half of this debt came due in the first half of the year, front-loading the supply challenge for investors and policymakers alike. This is not a future problem. This is not something economists are warning about for 2030. This is happening right now, in real time, while Washington is consumed by political warfare, while the White House is fighting the Federal Reserve, while oil prices are spiking from a shooting war in the Middle East, and while bond investors, the most cold-blooded and rational actors in the entire global financial system, are quietly, methodically, beginning to walk away. What you are about to hear is the story of how a nation reaches the edge of a fiscal cliff, not by accident, but by decades of deliberate choices, political cowardice, and financial engineering that was always destined to hit a wall. And that wall is here. Let us start with what is actually happening in the bond market right now, because this is where the real story lives. Most people look at stock prices, they track the Dow Jones, they watch headlines about tariffs or trade wars or who Trump insulted on social media today. But if you want to understand the true financial heartbeat of the United States, you watch the bond market. And right now, the bond market is sending signals that should make every American sit down and pay very close attention. The yield on the US 10-year Treasury note recently rose to as high as 4.48%, its highest level since July 2025, before retreating to 4.42%. Traders remain concerned about the impact of the war with Iran on both inflation and economic growth, as prospects for de-escalation remain uncertain and oil prices continue to surge. Now, those numbers might sound abstract to you, but let me tell you what they mean in plain language. When bond yields rise, it means investors are demanding more money to lend to the United States government. It means trust is eroding. It means the world is looking at Washington and saying, we need to be paid more to take this risk. And when you are trying to refinance $10+ trillion of debt, the difference between a 3% interest rate and a 4.4% interest rate is not a footnote. It is a catastrophe measured in hundreds of billions of dollars in additional annual interest payments. This past week, auctions for 2, 5, and 7-year Treasury notes all drew weak demand, forcing yields to go higher than expected. Think about what that means for a moment. The United States government went to the market to sell its debt, or debt that it needs to sell to keep the lights on, and the buyers weren't there. Not fully, not like they used to be. The short end of the yield curve is under extra pressure as soaring oil prices boost the inflation outlook and put additional rate cuts from the Federal Reserve on hold, with odds of a rate hike also increasing. Meanwhile, the cost of the U.S. war on Iran is worsening the debt picture amid reports the Pentagon is seeking $200 billion from Congress. So now you have the government needing to borrow more to fund a war, at exactly the same moment that borrowing is becoming more expensive, at exactly the same moment that the Federal Reserve is paralyzed between fighting inflation and supporting the economy. This is what professionals call a perfect storm. What I call it is the bill coming due. And here is the deeper structural issue that nobody in mainstream media is connecting the dots on. U.S. debt has now topped $38 trillion. The federal government already borrowed $601 billion in the first 3 months of the 2026 fiscal year. Trump has vowed to boost defense spending to $1.5 trillion a year from $1 trillion, threatening to further deepen federal budget deficits. And despite the Federal Reserve's series of rate cuts this past autumn, Treasury yields remain about where they were in early September, suggesting the government will not see much relief on debt servicing costs. Read that again slowly. The Fed cut rates 3 times. And yields barely moved. Why? Because the bond market is not listening to the Federal Reserve anymore the way it used to. The bond market is looking at the fundamental arithmetic of American fiscal policy and concluding that cutting short-term rates does not solve the underlying problem, which is that the United States government is spending far more than it takes in year after year, and the cumulative debt is now so large that servicing it is consuming an ever-growing share of every dollar that comes into Washington. The Congressional Budget Office projected that Trump's One Big Beautiful Bill Act will add up to $3 trillion to the national debt within the next decade, or $5 trillion including interest if the act's measures become permanent. U.S. Federal Reserve Chairman Jay Powell has expressed the concern that the level of the debt is sustainable, but the path is not. The path is not. Those are not the words of a fringe economist or a doom and gloom podcaster. Those are the words of the chairman of the most powerful central bank on earth, and he is saying, in the most polite Fed speak possible, that the trajectory of American public finance is unsustainable, that if nothing changes, the math leads somewhere very bad. Now let us talk about the political dimension of this, because you cannot understand the debt crisis without understanding the war that is happening right now between the White House and the Federal Reserve. This is not a sideshow. This is central to the entire story. Trump has put the Fed and its chairman Jerome Powell under intense pressure to lower borrowing costs. Powell said the Justice Department probe, tied to the renovation of the Fed's headquarters, was another attempt by Trump to influence the central bank's monetary policy. This is about whether the Fed will be able to continue to set interest rates based on evidence and economic conditions, or whether instead monetary policy will be directed by political pressure or intimidation, Powell said. And that statement, from a man who normally speaks in the most measured, technocratic language imaginable, tells you everything you need to know about how serious this confrontation has become. Why does Trump want lower rates so desperately? The answer is sitting right there in the debt numbers. Trump's repeated calls for the Federal Reserve to cut interest rates are set against the backdrop of $11 trillion in U.S. debt securities that will have to be refinanced over the course of the next 12 months. The cost of servicing the national debt has surged due to higher interest rates. If rates come down, the government can refinance all that debt at lower costs. If rates stay high, or God forbid go higher, the interest payments become an even more suffocating burden. So Trump's pressure on Powell is not just ego, it is not just political theater, it is a desperate fiscal calculation. Every percentage point that rates stay elevated costs the United States Treasury hundreds of billions of dollars in additional interest payments on that mountain of refinancing debt. But here is the problem. By refusing to cut rates, the central bank's leaders have asserted their independence from the White House. The Fed held interest rates steady, taking a measured, wait-and-see approach to the economy, and the Fed is holding firm because inflation is still above target. The Iran war's oil shock is pushing prices up as the labor market loses steam, a threat that makes the steep interest rate cuts that Trump is demanding increasingly uncertain. So you have this extraordinary collision happening in real time. The government needs cheap money to refinance its debt. The Fed says it cannot provide cheap money because inflation is still running hot, partly because of a shooting war that is driving oil prices higher, partly because of tariffs that are pushing consumer prices up, and meanwhile the bond market, which is watching all of this, is getting increasingly nervous and demanding higher yields to compensate for the uncertainty. The market has completely abandoned its expectations for multiple interest rate cuts in 2026. Traders are no longer just erasing cut projections, they are now pricing in a startling 40% probability of a rate hike by the Federal Open Market Committee before the year is out. Yields climbed nearly 50 basis points in just 4 weeks, a move that caught many institutional desks off guard. Think about the implications of that. Just months ago, the consensus expectation was that the Fed would cut rates multiple times in 2026. Now, markets are pricing in the possibility of a rate hike in the middle of a $10 trillion refinancing operation. This is the kind of scenario that keeps Treasury secretaries awake at 3 in the morning staring at the ceiling. And there is a geopolitical dimension here that is amplifying everything. Japanese investors have been among the most aggressive buyers of overseas debt, particularly U.S. Treasuries. Japan is the largest foreign holder of U.S. government debt, with Japanese entities holding about $1.2 trillion in U.S. Treasury securities. But now that Japanese yields are going up, Japanese bond investors may be more likely to stay home and invest in their own bonds rather than in U.S. bonds, putting upward pressure on U.S. yields. This is enormously significant and almost completely ignored in the mainstream conversation about the U.S. debt situation. For decades, Japan was essentially a captive buyer of American debt. Japanese investors facing near zero yields at home had no choice but to buy U.S. treasuries to get any return at all. But now Japan is normalizing its own interest rates, and as Japanese bonds start to pay more, Japanese money starts to come home. And when Japan's $1 trillion starts drifting away from U.S. treasuries, The United States government has to find replacement buyers, buyers who will likely demand higher yields. The holders of US debt have shifted drastically over the past decade, tilting more toward profit-driven private investors and away from foreign governments that are less sensitive to prices. This is the quiet revolution in the Treasury market that almost nobody is talking about. Foreign governments used to buy American debt not purely for financial reasons, but for geopolitical and strategic reasons. They wanted good relations with Washington. They wanted to keep the dollar strong because their own export economies depended on it. But now the marginal buyer of US debt is increasingly a hedge fund, a money market fund, a private institutional investor, entities that have no geopolitical loyalty whatsoever, that will simply go where the yield is best and the risk is lowest. And those buyers are looking at the US fiscal trajectory and starting to ask hard questions. Former Treasury Secretary Janet Yellen has warned that the preconditions for fiscal dominance are clearly strengthening, noting debt is on a steep upward trajectory toward 150% of GDP over the next 3 decades. Fiscal dominance. That is the technical term for the scenario where a government's debt burden becomes so large that the central bank is forced to subordinate its monetary policy, its inflation-fighting mandate, to the government's borrowing needs. In plain English, the scenario where the Fed has to print money to buy government debt because private buyers are not showing up in sufficient numbers. And that is the road to currency debasement. That is the road that has destroyed the purchasing power of citizens in every country that has gone down it throughout history. With such colossal refinancing, the currency could depreciate so quickly that even high rates will not be enough to preserve the real yield on bond products. Investors, concerned about the pressures associated with this debt wall, are turning to gold as a safe asset in the face of growing uncertainty, driven by fears of a possible devaluation of fiat currencies. And this is why gold has been making new highs. This is why central banks around the world, particularly China and Russia, have been accumulating gold at record levels. They are positioning themselves for a world in which the US dollar's role as the global reserve currency is diminished, not eliminated overnight. These things do not happen overnight, but diminished gradually, systematically, as the arithmetic of American public finance makes the dollar a less reliable store of value. The MOVE index that tracks volatility in the Treasury market has spiked to levels consistent with price instability and policy dysfunction. The warning highlights the role of bond vigilantes, traders who protest huge deficits by selling off bonds to push yields higher. Previous sell-offs have reined in presidents, including Trump, who pulled back on his trade war last year after the bond market turned on him. With the US now in an actual shooting war, bond vigilantes could throw their weight around again. There is a historical lesson buried in that statement that every American should understand. The bond market has more power over a president than any political opponent, any court challenge, any congressional opposition. When bond vigilantes move against the government, they can force a policy reversal faster than any election. And they have done it before. They did it to Bill Clinton in 1994. They have done it repeatedly to governments in Europe. They briefly did it to Trump himself when the tariff escalation pushed yields higher and he suddenly became much more interested in negotiation. The bond market does not care about ideology. It does not care about political affiliation. It does not respond to tweets or executive orders or angry press conferences. It responds to one thing only, whether the numbers add up. And right now, the numbers are not adding up. The debt to GDP ratio rose to 122.5% at the end of Q4. The deficit to GDP ratio at the end of 2025 was 5.8%. Over the past few years, anytime the 10-year yield approached 5%, demand just exploded and brought yields back down. That 5% line is the sound barrier that the 10-year yield has not been able to break and stay above for more than a few days since 2000. But notice that this 5% barrier has been tested repeatedly over the past 2 years. And every time it is tested, it gets closer and closer to breaking. Because the fundamental conditions, the deficit, the debt load, the inflation, the geopolitical instability are not improving. They are getting worse. The one big beautiful bill adds trillions more. The war adds hundreds of billions more. The demographic pressure of an aging America continues to drive Social Security and Medicare costs higher year after year. US political risk has spiked. During the first quarter of 2025, the International Country Risk Guide score for the US dropped from its historical average of 83 to 76, or by 2.5 standard deviations. Such deviations are substantial and can have noticeable adverse effects on a country's growth and government bond yields. 2.5 standard deviations. That is a statistician's way of saying something extraordinary and alarming has happened to the perception of American political stability. And when political risk rises, investors require higher compensation, which means higher yields, which means more expensive refinancing. The spiral reinforces itself. Sacrificing Fed independence could ultimately trigger the opposite economic and financial impact of what Trump is seeking. Mortgage rates are tied more to yields on the 10-year US Treasury bond than to the federal funds rate. If Wall Street sees higher inflation ahead, Treasury yields are likely to increase due to those perceived risks, and that would result in higher mortgage rates. This is the fundamental paradox at the heart of the Trump administration's financial strategy. The president wants lower interest rates to make borrowing cheaper and to reduce the cost of refinancing the national debt. But his efforts to pressure the Fed, combined with his spending plans and geopolitical decisions, are actually pushing long-term rates higher, not lower. He is fighting a fire with gasoline. The ripple effects of higher US yields are also being felt globally. As the US dollar strengthens alongside yields, emerging market economies are facing increased pressure on their own currencies and debt servicing costs. This dollar wrecking ball effect could force foreign central banks to hike their own rates defensively, potentially slowing global growth. So what begins as an American fiscal problem radiates outward into a global problem. Emerging markets, countries that borrowed in dollars when the dollar was weak, now face crushing pressure as the dollar strengthens. They must raise their own interest rates to defend their currencies, which slows their economies, which reduces global trade, which cycles back and reduces demand for American exports, which widens the American trade deficit further. The interconnections are vast and they all point in the same direction. What is the end game here? Nobody can tell you with certainty because these are complex systems with many variables, but the range of plausible outcomes is not comforting. In the optimistic scenario, the war in Iran de-escalates, oil prices fall back, inflation cools, the Fed can cut rates more aggressively, the refinancing gets done at manageable costs, and the new Fed chair nominated by Trump finds some way to balance political loyalty with market credibility. In this scenario, the problem is managed rather than solved. The debt continues to grow, but slowly enough that it does not trigger a crisis in the near term. In the darker scenarios, one or more of these things does not go according to plan. The war drags on. Oil prices stay elevated, inflation reaccelerates. If inflation data shows further acceleration, the 40% probability of a rate hike could quickly become the consensus view, potentially pushing the 10-year yield toward the 4.75% or 5.0% mark. A breach of that level could trigger algorithmic selling and a broader liquidation of equity positions. And if bond yields spike toward 5% while the government is trying to roll over $10+ trillion of debt, the interest payments become so enormous that they consume an ever larger share of every federal dollar, crowding out everything else: defense, healthcare, infrastructure, education, and eventually forcing choices that no politician wants to make publicly. As the government issues more debt, it may absorb investor capital that would otherwise go to corporate bonds or municipal projects. This crowding out effect can make borrowing more expensive for businesses and local governments, indirectly affecting economic growth and market returns. So the damage does not stay confined to the federal government's balance sheet. It spreads throughout the real economy. Small businesses cannot borrow, municipalities cannot finance infrastructure, homeowners face higher mortgage costs. The cost of living goes up not because wages rose, but because money became more expensive everywhere for everyone. The tragedy in all of this, and this is something I think about deeply, is that none of this was inevitable. The seeds of this crisis were planted over decades by both parties through tax cuts that were not paid for, through spending programs that were not funded, through a financial system that was allowed to operate as if the normal rules of arithmetic do not apply to the United States because of the special privilege of issuing the world's reserve currency. That privilege is real. It has given America extraordinary latitude, but it is not infinite. And the bond market, in its cold and merciless way, is beginning to calculate just how far that latitude actually extends. The question now is not whether there will be consequences. The consequences are already arriving in the form of higher borrowing costs, in the form of political paralysis, in the form of geopolitical vulnerability at a moment when American leadership is most needed. The question is whether Washington will find the political will to address the underlying problem before the bond market forces a resolution on its own terms. Because when the bond market decides to resolve a fiscal crisis, it does not do so gently and it does not wait for elections.